Joining us now as our closer today is Dan Rosensweig. He's the CEO of Chegg, former chief operating officer of Yahoo. Welcome, Dan. We'll certainly hit the Chegg news, but just on this FTC story, the agency wants to deepen its understanding of large technology firms' acquisitions. What are they going to find?
Well, it's going to be very interesting what they're going to find. I think most people don't understand that when you're a public company, you don't always need to report an acquisition that you made, depending on its level of what they determine as materiality. And if you're a giant company, you can swallow up really large companies and not have to tell anybody what you did or how you did it. You simply have to file something that says how much money you spent. So we don't really know all the different companies that these large companies have been able to buy. But it really is an unfair advantage if you think about it. The larger you are, the bigger you can buy things that are not material. So if there are private companies, you can gobble them up. You can either do it to prevent competition, or you can do it to advantage yourself over somebody else who can't afford to buy it. So it'll be very interesting to see what they find. But I think there's a lot there. These companies buy hundreds, if not thousands, of companies that we never hear about.
Wow. Now wait a minute. I mean, we're showing bottom of your screen that it says former Yahoo COO. I mean, you were one of these big companies. Now you're a smaller company. So you think there's merit to the FTC looking into all of these deals as still a big tech player out in the Valley?
Well, they weren't big tech players when I was at Yahoo, and they've become big tech players. And I'm not saying that they shouldn't be able to do them. What I'm saying is I don't see any reason why they shouldn't be transparent about what they do. I don't think there's anything bad about being transparent. If you're going to buy a company, it's not bad that people understand what you bought and why you bought it, particularly if you're a public company. So for our company, when we buy something, materiality is a very small number because of the size of our company and our revenue compared to a Google or a Microsoft or an Apple. So I do think that these are things that were never contemplated when these laws were written. Whoever imagined we'd be seeing multiple trillion-dollar market cap companies? I think it's a healthy thing to understand what should be disclosed and what shouldn't. I don't know that they haven't done anything wrong or anything illegal or anything nefarious. It's just what the rules allowed. Well, I think we should ask the question, is it the right rule anymore?
As someone, though, that competes yourself for top talent, for instance, intellectual property, I mean, what could the anti-competitive behavior be that they're after here?
Well, you know the ones you hear about, right, which is they want to also examine all the large companies. So if you take a company like Instagram, for $1 billion, which is what Facebook paid, materiality level is so small they probably didn't even have to disclose it if it didn't want to. So I think we're going to find technology. We may find things in AI, machine learning. There's lots of things that we may find that would be interesting to know that these companies have. If you're a consumer, you'd like to know what the technology is that people are using. But as a competitor, you'd want to know what it is that they have advantages over or where they're focusing on. I mean, that's the whole point of transparency and disclosure.
Let's focus on Chegg, if we could, for a moment. Look, it looked to me like you had good earnings. Your guide was above what the street was looking for. Your stock, though, got hammered today. What's up with that?
Yeah, that's a good question. We did have a fantastic 2019. We beat our expectations. We raised our guidance for 2020. And I think, look, this happens periodically, which is our stocks appreciated probably 40 or 45% in the last 3 months. So I think what you end up getting is a lot of people who made a lot of money, they clear out. And what that leads to is our larger investors who want to buy more can buy on the dip. And we've gotten lots and lots of good phone calls today from people who are seeing this as an opportunity to grab more of the company because the enormity of what we're working on continues to reveal itself. So I think it was just a matter of people sort of front running the stock, taking profits, and we'll see the next generation of investors. But the business itself is doing phenomenally well.
You still have a fairly large short interest, though. Does that concerns you? I mean, there are still people out there betting against you.
Yeah, well, that's part of the fun of life, right? We've had a huge short against us since, I think, before we were even founded, it feels like. So, no, we don't pay attention to. What we pay attention to is execution. And I think over time, we've seen the stock appreciate over 500%. But more importantly, the enormity of the business, the role that we play in the education marketplace, the students that we serve. I mean, we had nearly 6 million paying customers at the end of this year for businesses that we didn't even have 4 years ago. Our growth rate is over 30%. I think We had the highest subscriber growth we've had in a while at 32%. Our margins continue to get higher. So there are always people that bet with you, and there are people that bet against you, and that's the public market's opportunity to do those. We don't really focus on it because we just continue to execute, and I think the people that have bet with us have been rewarded significantly more than the people that have bet against us.
Well, it's been a big surprise story, Dan. I don't think people would realize that selling online textbook and materials would be, what, a 30% grower per quarter. How much runway do you have? How big is the market for those kind of numbers to continue?
Yeah, that's a great question. And so we do online textbooks, as you say, but really the core of the business is online homework help. And we only charge $14.95 a month. And the loyalty factor is incredible. We even gave the engagement numbers of over 2 million pieces of content viewed every day just in one of our services alone, which is Chegg Study, or 15 million visitors a month. So we have continued huge opportunities in North America alone. There's a lot more students that we can serve. There's a lot more ways that we can serve them. There are new vectors opening up, like online universities and community colleges, which historically we have not had significant penetration in. We're starting to make great headway. And then there's global growth. The difference between Chegg and, say, Netflix or Spotify or other companies that are global in subscriptions, aside from the fact that we're profitable, is the fact that in the big countries, the content is the same. STEM B is the same in every country. So our ability to grow internationally is much less expensive and much easier to do, and we're beginning to see that pay off. That's why you saw the accelerated subscription growth rate, because we see more North America growth as well as international growth. So we don't really see an end to the cycle anywhere in the near future. We continue to see newer and bigger and better opportunities. And the other wonderful part of it is it's extraordinarily profitable. Over 90 cents of every dollar in our subscription businesses falls to the bottom line.
Dan Rosensweig, thanks for joining us.